Welcome. This video is brought to you by My Shoe Covers, reusable and washable booties for residential contractors with a grip you can count on. If you're looking to buy, sell, or invest in a pest control business, one of the most important steps is understanding how to properly value it. While it may seem complex at first, the process becomes much clearer once you understand the core valuation methods and what drives value in a service-based business. In this guide, we'll focus on two of the most widely used approaches: asset-based valuation and income-based valuation, specifically through SDE and EBITDA. We'll also explore how to choose between them and provide real-world examples of each. If you would like to learn what drives a higher valuation for your business, watch till the end. Pest control companies are service-oriented businesses. Their value is not just tied to the equipment they own, but to their recurring customers, service contracts, technicians, and operational systems. That's why many traditional valuation methods that rely solely on physical assets fall short in capturing the full picture. Let's begin with the asset-based valuation approach. This method is most commonly used for businesses that are not profitable or are winding down operations. It focuses on the fair market value of tangible assets such as service vehicles, spray equipment, foggers, traps, chemicals, office equipment, and inventory. You total the value of all business assets and subtract any outstanding liabilities. The result gives you the business's net asset value. This approach can be useful when the business doesn't have significant earnings or is being evaluated primarily for its equipment and materials. Believe it or not, many pest control business owners use this method to sell all their assets before they retire. However, in most cases where the pest control business is operating profitably, the more accurate way to value the business is using the income-based approach. This method focuses on how much money the business earns and how sustainable that income is moving forward. For small owner-operated pest control businesses, the most common metric is SDE, or seller's discretionary earnings. SDE represents the total financial benefit a single owner-operator receives from the business. To calculate it, you start with the net profit, then add back the owner's salary, personal perks, one-time expenses, and non-cash deductions like depreciation and amortization. Once you have the SDE, you multiply it by a market-based multiple, usually between 2 and 3.5 for pest control businesses. This gives you an estimated business value. If the multiple is 3 times the SDE, it means it will take the new owner about 3 years to return the money they invested, assuming no growth or decline in current earnings. The riskier the business, the lower the multiple. Less risk or strong growth potential can result in a higher multiple. The formula is simple. SDE times multiple equals business value. The multiple already assumes the business includes all the essential operating assets like trucks, spray equipment, and standard inventory. These are called working assets, and they are considered part of the deal. So unless negotiated separately, their value is already built into the multiple. Also, the valuation is done on a cash-free, debt-free basis. That means the seller keeps any excess cash and pays off liabilities before closing. The buyer acquires the business with its working assets, but not its debt. For example, let's say a pest control business has a net profit of $200,000. The owner also pays themselves a $90,000 salary and runs $10,000 in one-time expenses through the business. That gives an SDE of $300,000. If a buyer applies a 2.5 times multiple, the estimated value is $750,000. That price includes all service vehicles, spray equipment, traps, and normal inventory required to operate. But what if the business is larger? It has a full management team, multiple service routes, and the owner isn't involved in daily operations. In this case, using SDE isn't appropriate. Instead, we use EBITDA, or earnings before interest, taxes, depreciation, and amortization. This method is better suited for mid-size to larger pest control companies that are being evaluated by investors or buyers who won't be stepping into an operational role. Unlike SDE, EBITDA does not add back the owner's salary or personal perks. It only removes interest, taxes, depreciation, and amortization to reflect the business's pure operating performance. This approach helps investors understand the profitability of the business without the noise of different ownership styles or financing structures. Okay, here's an example. Suppose a larger pest control company reports a net profit of $400,000, interest expense of $20,000, taxes of $50,000, depreciation of $60,000, and amortization of $10,000. The EBITDA would be $400,000 plus $20,000 plus $50,000 plus $60,000 plus $10,000, which totals $540,000. Now, if an investor is valuing the business using a 4 times EBITDA multiple, which is pretty common for larger, more stable companies with strong systems and recurring revenue, the valuation would be $540,000 times 4, or $2,160,000. Because this business is professionally managed and doesn't rely on just a single owner to operate, EBITDA is honestly the more accurate metric. It's also more appealing to investors who are looking for passive income or scalable businesses. So when should you use SDE versus EBITDA? Use SDE for small owner-operated businesses where the buyer will likely step into the owner's role. It reflects the full compensation and perks available to a working owner. On the other hand, use EBITDA for larger businesses with management teams, recurring service contracts, and potential for investment or acquisition. It focuses on clean, comparable operating profit regardless of who owns the company. Beyond the math, what drives a higher multiple in either case? A strong team, clean financials, recurring revenue from quarterly or annual pest control contracts, customer retention, and systems that reduce owner dependency all lead to a higher valuation. On the flip side, poor records, licensing issues, lack of technicians, and heavy owner involvement lower the multiple and the perceived value. For larger businesses, the same dynamic applies with EBITDA. A professionally run pest control company with steady EBITDA and limited reliance on the owner may receive a 4 times multiple or higher. If it's chaotic, overly dependent on one person, or has inconsistent earnings, it might only get 2.5 times EBITDA or less. If you're preparing to sell your pest control business and want to maximize its value, focus on building systems, documenting procedures, hiring and training technicians, and maintaining accurate financials. These steps reduce buyer risk and justify higher valuation multiples, regardless of whether you're using SDE or EBITDA. At the end of the day, valuing a pest control business is about more than just profit. It's about transferability, sustainability, and reducing risk. Whether you're a buyer or a seller, understanding these 2 core valuation methods will help you make smarter, more informed decisions. On behalf of the My Shoe Covers team, thank you for exploring this guide. Please like, share, and subscribe to our channel. Check out our other videos where we provide valuable tips to help you grow your pest control business.